In this week's update, the most vital earnings report and week of evidence in 2026, how it's changed the AI trade narrative, and why Q3 earnings are now absolutely pivotal. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. This video is mainly about the AI opportunity, but that is the biggest opportunity going around at the moment, so I think it's quite appropriate. And there'll also be, I think, a lot of things that you haven't heard before and probably are unaware of. So I think this has been a huge week. Certainly we've been in deep dive mode for weeks and weeks now, but we really did go for it in the last week because we needed to understand at a much deeper level some of the things that we had been tracking. There are numerous vital aspects of AI that were either unclear, and I'm sure you've probably heard a lot of them, or they were just plain untrue perceptions. And they've been going for several years. And I know I still speak regularly with people. Their first line is, the AI trade, it's not real, is it? I mean, it just can't be. There's just so many people that still have that view, and it's a perception only. But that has been clarified a lot if one looks deep enough, and we certainly had the opportunity to do that in the last week. So I think you're going to learn a great deal. So what the week proved is that the AI trade is real, and it's maturing, as all of these things do. So I can say with absolute confidence that the AI trade is real, and there's going to be a lot of people out there who are going to be surprised by what happens in the next few months, the next year, the next 10 years. If we look at Micron, MU, which reported on Thursday morning, and they were able to demonstrate with incredible clarity that the build-out of AI infrastructure is very real and that you can ignore the doubters. So I have absolutely no question in my mind about that. We then had Apple and Microsoft demonstrating that cost pressures, the cost of hardware, is escalating and that those cost pressures matter. And I'll have a bit more to say on that shortly. And then we've got AWS, which is part of Amazon, is also proving that scarce AI compute capability is valuable. It can be seriously monetized. But which companies capture the economics and which companies are paying the bills is really, really vital. And that became incredibly evident from a number of those major players. And we're talking about trillion-dollar market cap companies here. We're not talking about the small end of the spectrum at all. So that's what the week proved. But it also proved that we're into the economic proof phase. The market is maturing and it wants to see the economic proof. It doesn't just want to see demand. It's just not enough because there are too many astute people who are asking the questions that should have been asked 12 months, 2 years ago, but they're asking them now. And that is, show me the money, show me the economics around how this is unfolding. And that proof needs to be hard, factual evidence. It has to be about pricing power. It has to be about demand that is funded. There's no point in suppliers having massive backlogs if their customers can't fund the purchases over time. It's about margins, and Micron adequately demonstrated all this: margins, cash conversion, converting revenue into real free cash flow. And it's about the payback, the credible payback on all the capex, all the hundreds of billions of dollars that are being spent. When's the payback going to happen? So that's what happened last week. And I'm sure that's probably a lot more than most people realised. We were also able to get some insight into what won't cut it, and that's stocks that are just, they're on the gravy train. They've got some AI excitement around them, but it's vague. Nobody can really nail what it is that is going to be advantageous for them commercially. They are saying the future funding is needed, but we'll get it. Just trust us. That's not going to cut it anymore. And stocks that are in that position, I think you're going to see them under some price pressure in the next few months. And other stocks that have got very stretched valuations, they don't make any money yet, but those valuations have been punted up really hard by the market just because they're standing in the right room, but they don't have any proof to go with it. So the way that we see it is that the AI market, which is the biggest opportunity on the planet right now, is at a crossroads, and that we're past the stage where a rising tide lifts all boats, and so therefore you can be really lazy about your investing. That time has passed. So the AI trade now starts to fragment into huge winners and huge losers, and we're starting to see that already. The opportunity, when you stand back and look at the totality of it, there's no question in our minds that the opportunity is now bigger than what we thought it was. And part of that is because the demand has been proven as absolutely real and sustainable. But there's a big but coming here. The suppliers and hyperscalers and software companies and the companies that are funding this merry-go-round are no longer moving together. They have been for most of the past 3 years, but that is no longer the case. So this is a very important crossroads, and the Micron result has really shone a light on that. And if you dug deep enough into the results and all of the consequences of that, then it's given us a great deal more clarity. So the strong demand is not enough. It needs economic proof. And we know what that economic proof looks like. We know what things to monitor. So the upcoming July earnings, and there's quite a bit of it, not all of it, but quite a bit of it within the window of July 15 to July 31, that window is absolutely critical. And the guidance that the hyperscalers provide, and for those that don't know what that term means, that's Google, Apple, Amazon, Meta, all those guys, that must validate the enormous capex that they're spending. And it also must show that higher hardware prices can or cannot be absorbed. Absolutely critical. So that window that's only a couple of weeks away will be incredibly telling in terms of the information it provides. The picks and shovels companies like Micron, their results matter individually, but frankly, Micron's results have really adequately proven that there is a real supply-demand gap. There's no question about it, and the gap is massive. So we don't need another half a dozen picks and shovels results to tell us that that's true. We know it's true. The evidence is already there. And as I said earlier, a rising tide is not going to lift all boats anymore. So you just need to get smarter and more responsive to really tap into this. When we look at the financing chain, if big players disappoint the market in this financing chain, then it's going to be nasty. And the pipeline is going to suffer. So that demand pipeline, that huge backlog of orders will start to look very brittle. So it's just incredibly important that you really understand and know how to interpret this upcoming earnings window, because otherwise you could really get your backside smacked. So knowing who relies on who as far as the earnings rollout goes will be absolutely pivotal. So make no question that 2 weeks in the latter half of July and maybe the first week or so into August will be the most important reporting period of the year. And the good news for our members is that we're already building a map. We know a great deal about what we need to monitor, and more than that, how to interpret it. And we have learned a huge amount in the last week, because what has happened in the last week has forced us to dig really deep. The next phase, which comes after where we've been, is going to be really interesting. The easy phase was buying from the end of 2023. You just bought the theme. Anything with an AI badge probably did pretty well. Yeah, there was a bit of volatility thrown in there by Trump tariffs and the Iran war. but that was just noise, really. So the easy phase has gone, and you really need to understand and accept that. The next phase is the next big money opportunity where you've got to identify the companies that can monetize this. And we are really confident and comfortable that we're going to be able to do that. Now, some of those companies we're not clear on yet, but what we are clear on is the process that we use to find out. And we'll find out right near the starting gate. So it'll be a combination of the results themselves interpreted in the right context and then seeing what the market response to that is. So there's really three parts to it. So some big questions. Will the hyperscaler customers accept higher prices if indeed that's what happens? Prices keep escalating. So will their customers accept that? And we've already got some evidence that price rises are coming or are here. Apple needed more revenue to justify the capex, so it raised its prices. We haven't yet seen how customers will respond to that. So that's really important. And we'll see that in the next earnings period. And AWS, ditto. They have to get more revenue to justify what they've been doing. And so they've been raising prices as well. So what must investors have to really get on this train and do well out of it? And as I said earlier, interpretation is critical. It matters a lot. You can't just look at well, I suppose you can, but you're only going to get a very limited picture if all you do is look at the earnings results. You look at the growth in revenue, the growth in earnings, the cash flows, those sort of surface things. It's just not enough. You've really got to dig a lot deeper than that. And the July earnings period is when you really need it. If you're in the AI trade, then a lot of change could come very, very quickly in either direction. I suspect that the July earnings phase will give us some really big winners and some really big losers, and you just need to be responsive to that because the market has moved on a lot of assumptions about what will happen. And I'm very sure that some of those assumptions will be proved to be very wrong. So what to expect? I think it'll be one of the most volatile periods that we've seen, including the war period, including the tariff period. It'll be quite nuanced because there's a lot going on underneath the surface that needs to be understood to put it in context. But it's also going to be potentially one of the most profitable periods for those who are, if I can put it in these terms, really on their game. And we feel that we are, but we're just going to continue digging because it's just such a fascinating period. So the market will sort out who are the winners, who are the payers, and who are the passengers, the hangers-on. So selection of stocks, ETFs, whatever it is you're doing, selection is absolutely critical. And it's absolutely where investors need just calm, disciplined, evidence-based guidance. No personal biases, no surface research. There's only one way to do this, do it properly. And if you do that, then to a degree, there's a world is your oyster kind of opportunity here. One that you won't see too many times in your lifetime. But equally, there is a degree of unexpected outcomes. So how we've played it so far this year, or really for the last 12 to 24 months, we've been able to identify AI opportunities early enough for members to be able to register major gains in SMH, which is the semiconductor ETF, in Micron, in Celestica, in Vertiv, and in a whole bunch of other stocks as well. Now, a great many, in fact, nearly all members watch this Sunday video. So there's no way that we can claim that unless it is absolutely true. And we've certainly had lots of feedback from members who've done brilliantly in their minds over the last 12 months, 2 years. But what the result of our last couple of weeks of digging has done is that we're changing our framework because the market's evolving. So we have to change our framework. and it's absolutely critical to avoid losing the gains that you've already made. But we've got a roadmap. We think we're asking a lot of the right questions around payback, pricing power, margins, cash flow, quality of backlog. All those sort of questions are well below the surface, and you've got to go and dig for them. Now, we've had an offer running during June, and we're ending it in a couple of days' time. But it's not about influencing you to make a panic decision. This is about process. And we've been very strong on process, and you need to be inside that process before the July earnings window happens. So that is just a tick over 2 weeks away. This is a slide I put up a few weeks ago. It's just a bit of a summary of what we do. You're getting information daily. It's about context. It's about perspective. There's no bias or agenda. There's no egos in our crowd. We just want to learn and get better and better. And that's what we've been doing for 18 years. So you need that constantly refreshed perspective, and you need it from people who really understand what's going on under the surface. We're not anchored to yesterday's view. It's very easy to do that, as I'm sure viewers are aware of if you've been an investor for any period of time. Our business is purely about gaining the best possible outcome. That's how we thrive. We help members to do as well as they possibly can. So it's a very clear process. We focus on megatrends, quality stocks, money flows, all the things that matter. We know what our entry and exit plans are, and we know them in advance. We know them before we start, before we buy. And the result is that we've got an approach to really high growth companies because there's so many of them. Why not? Why would you want to be in something that's going to grow at 5% a year? I mean, it's boring. So there are just so many high growth opportunities. And we're very strong on managing risk. Members get it every day about risk management shoved down their throat. And our results, for people that are interested, they're visible on our website. In terms of the offer, it's closing on June 30. It's been open a little while now, so if you haven't moved, then there's not that long to go. It's $149 a month for the first 2 months, and then after that, $249 a month if you find that it's for you. It fits in terms of what you're looking for, or perhaps it helps you realise what it is you should be looking for. There's no lock-ins. If you try for 1 month and you don't think it's a fit for you, then that's fine. What's included? Entry and exit recommendations put out on a daily basis. There's not activity every day, of course, but you need to be up to date. When markets are this volatile, you can't be getting information once a week or once a fortnight, as many services do, because too much has unfolded. I mean, a stock can crash or go to the moon in the space of a week. Really important is the perspective, the context, videos. There is a phone onboarding process, and there is a lot of email support. I don't think you'll find better anywhere in the country, but I'm a little bit biased, I guess. So the real value that's in there is that if you do your part, so this is a collaborative effort, if you do your part, you'll have a plan that you've created, not that we've just handed to you and we hope it fits. You'll create it. You'll get all the execution support you need, not just recommendations. Recommendations on their own they're almost worthless. Just forget about it. You've got to have all the other stuff that goes around it. And that helps avoid abrupt changes in the market. And I'd like to bet that this July earnings window is going to prove up a lot of very abrupt changes. And they can cause some terminal damage, particularly if you don't get out of the way really quickly. But stocks moving 20 and 25% in a single session has not been unusual in recent months. And coming this week to members is the next bottleneck. So memory is currently the major bottleneck in the AI supply chain. But what's next? Because that's what we should be looking for now. We're in a phase where memory is a bottleneck. We know that already. we got to be looking for the next one, and we are. And we got a pretty clear idea of where it's coming from. But that July earnings window in 2 weeks will really give us the information that we need. I've spoken regularly about risk, and that's the first thing that you should be doing. And as part of managing risk, you just need to get all your proper advice lined up first before taking any action. Because whilst this market opportunity is getting bigger and better and more exciting, it's also getting more risky for those that don't have their plan organised. It's as simple as that. Let's look at the American stocks and then we'll get to some charts. The S&P was down a bit over 2%, and NASDAQ a bit over 5%. It was a down week in the end, despite the sensational results from Micron. The Russell 2000 IWM as the ETF was up 1.4%. So that was a surprise when I calculated that. So that tells you that money was not deserting the market. There's no nervous money here. And it's also validated by the fact that the VIX didn't break through 20, which is pretty modest. The only conclusion is that money is rotating. Money that's got a lot of embedded profit in it, in the semiconductor and tech sectors, is rotating. And that's normal. It's really healthy for that to happen. So the index weakness last week was because we just had some concentration. The hyperscalers were down. It's not broad-based weakness at all. So in many ways, it was actually a very encouraging week, despite the drop. And again, because we were digging more deeply than we ever have before, it is now so screamingly obvious to us that surface reporting is always late. It's nearly always misleading, and it's grossly inadequate in volatile markets. That I've never seen that situation with as much clarity because I've now got a different context to look through. So it kind of leaves you feeling that if you're in a leaky boat and you've only got a very small can to bail out, it's not a good situation to be in. And we certainly are not in that situation. And it leaves you feeling like you could have performed so much better. I mean, has anyone felt that over your investing years? Get to the end of the year and, it's an okay result, but gee, I could have done better. But I've heard that a lot from people who are thinking about joining the Insiders Club. So for once, you've got an opportunity to get your positioning and your timing far, far better than probably what you've ever done before. The US dollar index was at 101.37. The 10-year yield pulled back a little bit on Friday, 4.37, and the VIX was back to a pretty modest 18.4. That's about typically average for what we've seen of late. Time to go and look at some charts now. This is the NASDAQ composite, and you can see this is a daily chart, so you can see we gapped down on Monday, and then we continued down, but a little bit of a turnaround happened on Friday. On a relative comparison basis, looking at the technology index, so this is XLK, which is the main technology sector for America, we've got semiconductors still leading the way by an absolute country mile. But notice at the end of the week, semiconductors turned down and cloud computing and cybersecurity and software all turned up. Now, it's only one session. It's only a little blip, and these trends just might continue on. But it's interesting, something that we take notice of. Next is SMH. So there's the semiconductor index on its own. And there's nothing really dramatic there. We've got a couple of gaps, which I guess if you join the dots in the gaps, they would show as quite large red candles. So I guess we need to take note of that. But look, there was a big gap here, and then we had a fairly lengthy candle, but quite indecisive on Thursday, and then another gap down on Friday, but again, very small candle. there's really no follow-through. I'm not seeing a lot of commitment to sell this market. Let's look at the relative comparisons over the last quarter. This is XLK at the top, so cooled off a bit, and everything else didn't really do much. We did get a kick up in healthcare, but that was about all. In the Australian market, everything got hit except healthcare. So everything pretty much down. Next, the S&P, very similar, but just smaller fluctuations than the Nasdaq Composite. So that's on a daily chart, so you can see it's exactly the same pattern. Big gap Monday, down a bit, and then a reversal on Friday. And there's the Russell. So this was the surprise for me. This is the most significant divergence that I've seen in quite a while. The Nasdaq down 5%, but you've got the Russell 2000 up. Interesting. Let's look at currencies, because currencies are absolutely critical, particularly for the commodities trade. So that's DXY. We've broken out, rose further during the week, had a bit of a sell-off on Friday, but came right back off those lows of the session. And the Australian market is the mirror image of that. So we're back into falling down into the bottom of that trading range. So that's where the American market sits. Let's move into Australia. Our dollar finished at 68.85, so we've now come down about 2.5 cents in the last few weeks. Our index was down 1.3% for the week, but I just find it a waste of time looking at it, frankly. It doesn't give me any information that's worthwhile. And the other thing that I just been shaking my head about for years and years, and I express my frustration every now and again in this video, I don't get the "you must own energy" rhetoric from people who should know better, because it really doesn't hold water. If you look at XLE listed on the Australian market, in the last 20 years, it's gone absolutely nowhere. So let's just have a quick look at that. This is XCJ, which is the Australian Energy Index. Here is where we are at the moment, and here is where we were 20 years ago, 21 years ago. Now, we've had a fair bit of volatility in between, and maybe you're good at getting in and getting out at appropriate times. But if you're a long-term buy and hold investor, that's the reality. Now, this doesn't reflect dividends, but frankly, there is so much capital gain on offer that I think if you're in a sector where the capital gain has done nothing for 2 decades, then you've been missing a major, major opportunity. That is for sure. On the other side of the coin, there are so many fabulous opportunities. They can be isolated stocks in sectors, or they can be a good slice of a sector, but they've got great fundamentals, they've got huge runway for growth, and they've got existing momentum. It's just some fabulous opportunities. Let's look at precious metals now. Gold was down 3.2% for the week, so we actually dipped down under 4,000. I'm a little surprised by it. No, I'm not. I'm a lot surprised by it. But it's the US dollar and the preoccupation with yield that is doing this, and it will reverse. I'm very confident of that, but I just don't know when. In Aussie dollars, we've dipped under 6,000. Silver was down a massive 13%, got really volatile, and we dipped under 60 in silver. Look at those charts in it. So gold is now, or was down at the lows of last week. It was down 28% from the peak. And you just don't want to go buying into this at the moment. You really don't, because this is like trying to grab a falling knife. You just do not want to do it because we don't know where the bottom is. Having said that, my confidence is still high that we've got a generational buying opportunity in our lap between now and the end of the year. And probably November, December, they are the traditionally strongest periods for gold and gold stocks. And I just don't know the timing. It may hit earlier. There'll certainly be some impact from what the Fed says. There'll be some impact from whether this war is finished or not. So they're unpredictable. So it could be delayed another 3 or 4 months. So the best way to play that, and I've been showing and saying for quite some time now, that the gold S&P ratio is the key and it hasn't turned yet. So you've got to wait for that. When we look at gold stocks, GDXJ, we were down 6.5%. And I think the best thing to do is just some loose monitoring. Don't worry about it every day, because this is not going to turn on a dime. This is not suddenly going to go up massively and you'll miss out. And if you keep watching this multiple times a day, looking at your favourite gold stocks, you're going to get sucked in. You're going to make some unfortunate decisions. So just step back from the gold market. You don't have to sell it. In fact, I don't think that's a good plan. As I said last week, it's an opportunity for rebalance. So you don't just throw it all out. You reduce your exposure so that if there is continued downside, it doesn't hurt as much and it gives you some capital to use when the time comes. So let's go and look at that part of the market. Silver, you can see on a daily basis, we had a particularly rough day on Tuesday and Wednesday, so it opened the week in pretty poor shape, a little bit of a bounce at the end, but we've now gone deeper than I thought. And the next support is pretty obvious. It's around 54.4 for silver. This is gold, US dollar gold weekly, and we've seen a pretty decent fall. This is nothing unusual. This happens in most bull markets. It's just things were looking so very positive up here around 4,700, 4,800. Fundamentals, technicals, they all look great. That this has been a bit of a surprise, but step back. We've had an A, B, C correction, which fits in with psychology very nicely. And we might be close to a bottom, or we might be close to going into a period of consolidation where we get short rallies and then sell-offs, short rallies, the sell-off. But ultimately, I think by the time we get to the end of the year, things should be looking pretty good. And if we look at the spread between the US dollar and the S&P, you can see the trend is still strongly down. We're down to 0.56, so we don't want to move on that just yet. Turning quickly now to other commodities. This has been a long video, but there's just so much of importance to get across to everybody. Copper, $6.14. It's just been tossed around. It was $6.50, $6.60 a couple of weeks ago. The seas are pretty heavy. There's a lot of crosswinds, a lot of things going on under the hood. So that's where we sit with copper, but nothing has changed. Crude oil finished at 77. Is the war over or is it not over? I don't know. So for me, it's too hard. It's too unreliable. And if we look at the differential, so for those of you that have been influenced to own energy in Australia, which is so unpredictable because government policy is just an absolute diabolical mess on all sides of politics. I don't think anyone has any idea what they're doing with energy policy. So I've been avoiding the Australian energy market for a long, long time. So let's just have a quick look at that comparison because it is quite telling. So on the top in green, we've got XLE, which is the US energy sector. And on the bottom in blue, we've got XEJ. So you can see XEJ, and we've gone back to 2005. So XEJ is exactly where it was 21 years ago. Plenty of volatility, but at net, it's gone nowhere. But at least there's been some significant capital gain available in the US if you're a long-term holder. So if you want to be in energy, then there are plenty of ETFs in America that will give you that sort of exposure. All right, we're getting close to the finish. There's Bitcoin. We just broke 60,000. Whether it proves to be a false break or not, we'll see. But that's not great, and we're definitely in downtrend. There's the spot copper chart, a little bit of a bounce Thursday and Friday. We were under $6 at one stage. There's crude oil. We've broken 70. The final message, wrapping it all up. It's all about process and probabilities. And if you listen to this video on a weekly basis, you're probably sick of me saying that, but there's nothing new. When there's terrific opportunities available, you just do simple things, you do them repeatedly, and you do them well. So it's just about process and probabilities. It's not guessing, it's not hope trades. There is a firm process for how we select, how we buy, and how we exit. There's nothing really left to chance. We know it all before we buy. So snap judgments, emotionally driven decisions, and you're going to be influenced to do all of this in the next few months, probably the next few weeks, because I can just see so many reasons why the market is going to be ultra volatile in the next month. So you've got to put yourself in an environment where you're not doing this. Playing catch up is just going to kill your returns. So you've got to find a better way. If you've not been getting the results you want, then it's an absolute folly to continue doing the same thing. You've got to change something. How many times, let me ask you a couple of questions. How many times have you done really well and you've made terrific money, put a big smile on your face until the cycle shifted, and then you just watch months of hard work, it's just gone in a few days? I know I do it less, way less these days, but I spent decades doing that, so I know what it's like. It's easy to get caught in the flow of a winning environment. You think this is fantastic, and you just sit back and relax and watch it happen. And you just lose sight of the change until it's too late. And 99% of investors really have no ability or inclination to do the deep dive to see these changes in advance before they hit. There's no negative there because it's really, really hard. People have got full-time jobs. I'm in the terrific position that this is all I do, so I can do deep dive immersion to my heart's content. The message is you just don't have to be a victim over and over and over again. The cycle's getting you yet again. You just don't have to be that person. It's very simple, so you don't have to do anything that's hard, but it's just challenging. It's challenging your emotions and your biases. So you must have someone who's tracking the unfolding commercial reality in real time if you want to win big and avoid the potholes along the way, because you won't be able to do it yourself. You've just got to be too much with your finger on the pulse. So if you're prepared to do a little bit of work and stay on top of what we're putting out to members every day in written form and in video form, then I will ensure that you will clearly understand what to do. I can't guarantee you results because you contribute to that in part, but I will ensure that you have all the understanding, but you've got to do a bit of the work. So there's no free lunches here. Having said all that, very long video. Yes, there are some potholes on the horizon, but I'm really bullish, despite the challenge of the volatility, which I'm sure is coming. And the reason for that is that we've done the really deep dive research. If we hadn't done what we've done in the last weeks and months, then I wouldn't have that confidence. We've been able to refine our perspective, and so all I see is a fantastic opportunity, but some ongoing diligent work. So I'll leave you with those thoughts. There's more information on the website, and there's my email address. And the opportunity for our end-of-year offer, the details will appear below this video. So that's it for now. Cheers.